Hi, my name is Shreyans, and today we are going to do a basic financial analysis of one of India's largest companies. Largest not just in that particular industry, but amongst all Indian companies. And it belongs to an industry which has really elevated India's position in the global economy as well and helped the world recognize the talent that comes out of India. The company that I am talking about is Infosys. So, if I remember correctly, Infosys is the second largest provider of IT services, consultation, and currently a lot of the IT companies are focusing on digital transformation as well. It is second only to TCS, if I remember correctly, right? So, IT services consultation basically includes providing platforms and software products to companies so that they can manage their operations well with the help of technology, because it has become such an integral part of different industries, right? And so majorly these companies are B2B players. All right, so first let's start with the financials, and then we'll move on to some metrics, and we'll wrap up with the highlights. So if you look at the revenue, EBIT and PAT here, so there has been a very decent trend, there has been a very decent growth in all three. The thing to see here is that revenue is up 3.3 times, but EBIT and PAT are up only 2.3 and 2.4 times, right? So this is something to watch out for, that a lot of the revenue growth hasn't converted into profit growth at a similar level, although the trend is still very decent in respect to that. So 14.2 CAGR in revenue, but only a 9.8 and 10.4 CAGR respectively in EBIT and PAT. But overall, the growth is very decent. Now, talking about the cash flow from operations, so cash flow from operations also has had a good growth, so to speak, but the cumulative cash flow is actually less than the cumulative PAT. This is something that, after looking at a few IT companies, this happens with a lot of IT companies. That is what I was able to understand, right? Because they have long payment cycles as well, they have long term contracts as well. So that might be one reason. But yeah, in I think in 5 of the 10 years, the CFO was sorry, in only 1 of the 10 years, the CFO has been greater than PAT here. So in most of the years, the CFO has been lower than PAT. So that is about the cash flow from operations. Looking at investing and financing activities, so with investing, so you could see that there are outflows and inflows and outflows and inflows, right? It's been that ways. Now, the thing to understand here is that there has been continuous reinvestments into assets. So this is something that you can see, that the asset base has continuously increased. But IT companies also produce a lot of cash, right? They produce cash in a very huge amounts, and they place those cash into investments as well. So a lot of, in fact, the current assets would also contain investments. So that is why you see that inflow and outflow. There have been significant investment transactions as well. With cash flow from financing, there have been hardly any borrowing related transactions. Most of this actually relates to dividend payments. So the company has continuously paid a lot of dividend to its shareholders. Now, talking about the balance sheet position, again, decent growth in equity. So this is somewhere near the PAT growth rate, right? And that is expected for such a large company because it has similar basis. Now, with current assets, if you look at it, a large part of these current assets would actually be investments held, and especially when the figures start going very high. And if you look at the fact that the current assets are actually more than sufficient to cover for all liabilities, not just current liabilities, but also non-current liabilities. So that is the amount of cash that these companies generate, and a lot of these current assets would be placed as investments, right? Non-current assets, continuous growth and investment into non-current assets, right? And it seems that the company also undertook a major expansion very recently. So one major expansion seems to have happened here, and one major expansion seems to have happened here. And let's see how the next year goes with all the digital transformation that is going around in so many industries, right? Current liabilities have, so to speak, they have grown at a decent rate. I mean, mostly in line with revenue, slightly higher, but they are more than sufficiently covered by the current assets. Non-current liability is very insignificant. Now you see negative figures here. Obviously, this cannot be negative, but because we've taken data from external sources, so they reclub or reclassify few items and net off, and that is why this non-current liability figure is being shown as negative. But even if you look at the actual balance sheet position, the non-current liabilities are very insignificant. there has been a sharp increase, so to speak, in FY20, but still it's very insignificant at the whole balance sheet level, right? Now, talking about the growth on the different financials, high level financials. So, if you look at here, very good growth, so to speak, in revenue, EBIT, and PAT here. So, in the last year, probably revenue was not that good, but EBIT and PAT were very decent, right? And in this year, revenue and EBIT were good, but PAT wasn't that great. But in the recent 4 years, so if you look at the recent 4 years, probably it has not been that great for the company. Just one good year per se from revenue perspective, and one okay share from PAT perspective. But apart from that, it has been very very low growth, so to speak, especially when compared to the historical standards of the company, right? Cash flow has been good. Cash flow, the growth in cash flow has been surprisingly more consistent and better than the growth in PAT, so to speak. Equity, very decent growth. This is something that can be fairly expected. Investments into assets as well, and then investments, financial investments being also made by the company. Current assets less current liabilities. So these the growth here is not really very very relevant to look for, because we understand that the liquidity position is very solid, right? And like the growth in liabilities is also, I mean, not something that is very very important to look at, because the solvency position is also again very solid. Now, let's look at the metrics of the company. So, if you look at the ROCE and ROE, you can see very good figures in throughout, very good return on capital ratio. So, median ROCE is 27.4 and median ROE is 24.6. So, I mean, whatever the capital the company has invested, it is able to earn one fourth of that as profit in 1 year. So, this is very good, and this is again characteristic of the IT industry as well, right? If you look at the EBIT and PAT margins, so EBIT and PAT margins probably in the recent 2 years haven't been that great, right? On the recent years, it has been on the lower side. In fact, the minimum here is of FY20, right? But on an overall, on a general basis, the margins had broadly been maintained, at least in these years. There is a broad declining trend, so to speak, but still these margins are comfortable. But it will be interesting to see how the margin, if the margin can expand next year in going in FY21, right? Asset utilization has sort of improved, or sort of broadly stayed the same. So the margins are probably at the lowest, but the asset utilization are, and or the capital utilization is at its highest in the current in the most recent year. So that is why the company is still able to maintain good return on capital ratios around the median. So EBIT and PAT margin at the lowest, capital and asset turnover at their highest, and return on capital and return on equity very much near their median, right? Now, talking about the liquidity and solvency related metrics. So asset by equity, which is the financial leverage, very comfortable position. I mean, the company's current assets are actually sufficient to meet all the liabilities, right? As we were talking about the cash conversion, so if you look at the cash conversion, it has sort of improved in the recent years. So in the recent 4 years, it is higher than the median here. But still, I mean, the cash conversion or the cash flow is not up to the level of PAT. So again, this is something that we need to see, that if the company can further consolidate its cash conversion, right? Net cash flow, I mean, so this is mostly dividend payments that are being paid out by the company, and the operating cash flow is more than sufficient to cover for the dividend payments and also the reinvestments. So if you look at the overall cash flow position, it's still a positive. So because these IT companies generate a lot of cash, so it is comparatively easier for them to reinvest and pay out dividends versus other industries, right? So current assets less current liabilities. So as you can see, these are very very high numbers, right? And obviously not all of this is actually working capital. A lot of the difference is actually invested into financial instruments for long term, or mostly for short term, right? So this is not the exact working capital position, but as you can see, the liquidity position is very strong. And non-current liabilities to equity, again, as we saw, it's just immaterial non-current liabilities, so to speak, right? So let's quickly wrap up with the highlights of the company. Strong revenue growth, right? Decent EBIT and PAT growth, but low growth in all three in the recent years. So this is something that we saw. Cumulative cash flow from operations is less than PAT in 9 out of the 10 years, right? And all that has been sort of improving. and cumulative CFO is only 84% of cumulative PAT. So this is something that is sort of not very good, so to speak, versus other industries as well. So the cash conversion, there is scope for improvement. Continuous reinvestment into assets, this is something that we've seen, and significant investment transactions as well. So placing the excess money as deposits or as investments and then redeeming them sometime later. And then CFF primarily includes dividend payments, right? Okay, there is a spelling mistake. Let me just correct it. So CFF cash flow from financing primarily includes dividend payments. Decent growth in equity, this is something that we've seen. Immaterial leverage and liabilities. I mean, so very, very low liabilities, and the leverage position is very, very comfortable. Significant investments are held as current assets by this company, and those current assets are also such that they can take care of the solvency or the liquidity requirements of the company. So that is the quantum of cash that is being generated, excess cash that is being generated actually. The return on capital greater than 25% in 9 out of the last 10 years, and return on equity greater than 20% in all of last 10 years. So very good return on capital ratios as well. EBIT and PAT margins have broadly been maintained, but they're their lowest in the recent 2 years. And capital and asset turnover have again broadly been maintained, but at their highest in recent year, which is despite the expansion as well, as we saw that here the non-current asset has significantly jumped. So this is something interesting, and due to which the company has been able to maintain its return on capital ratios. So what is the conclusion? My understanding is that the company has very strong financial position. There is no sort of liquidity or solvency related issue. Very good performance, very good shareholder payouts as well, because the company has consistently been paying dividends, but limited growth in the recent years. And also with IT companies, we have to remember that the growth is a function of two things. One, on the one side, we have the actual growth due to increase in customers or increase in value, and the other is related to the depreciation of the rupee, because a lot of these companies provide services to the primarily American markets, and also to European markets as well. So depreciation of rupee also inflates revenue. So if you're going to analyze any IT company, please differentiate between the two. All right. So that is all that I had to share about this company. I hope you found this helpful. If you have any questions or feedbacks, please drop them in the comments below and I'll get back to you. Uh, the link to the Excel sheet is available in the description. If you want to receive this and much more straight to your inbox, please subscribe using the link in the description. Thank you so much for watching, and I'll see you again with another company.